Good morning. Good morning to all the BSc, BCom General as well as Computer Section A and Computer Section B students. And today we are going to discuss about insurance products. What is the meaning of insurance product is the various types of policies or various types of services what the insurance company is providing to the insurance holders, that is a policy holders, comes under insurance products. So we learn in detail about the insurance and insurance products also here. Okay, so definition of the insurance according to American Risk and Insurance Association, this is the definition what they gave there. Insurance is pooling of fictitious losses, means unexpected losses. It is expecting or it is planning beforehand, and it is creating the finance for that risk which is going to occur in future. So what is the meaning of pooling here? Pooling means gathering. 1 crore of population are paying the policies. So 1 crore of population is paying 24,000 rupees per year, means how much cash is available with this insurance company in a year. Okay, financial stream. This stream, how to arrange for the losses which occurred today, which occurred tomorrow, which are going to occur in next future. Clear? So that is fortuitous losses occurrence. Rendering that services comes under insurance according to American Risk and Insurance Association. So basic characters of insurance, if you see, pooling of losses. Pooling of losses means in front of you, you are keeping some questions. Which questions arised because of your experience in this insurance field previously? What type of situations you faced? Okay, how you overcome the risk? How you paid the risk? So what type of problems may occur? You are getting a clear idea about these losses. So that all losses you are keeping on a piece of paper or a printed material and thinking the solution, and you arrange the solution for that. So other sources you are arranging for that losses is called as pooling of losses. Okay, payment of fortuitous losses. From this losses, how you are paying, for whom you are paying, what is the loss, how the loss occurred. Okay, next one is risk transfer. Okay, small example I will give you. In your class, there are 60 students in your class. Okay, for the benefit of your class, what you did, you collected 100 rupees from each person. So how many rupees are there nearly with you? 60 students are there. Okay, 10 into 100, 600. Next, how much you got? Nearly 60,000 rupees you are having with you. So any one person met with an accident, means out of the 60,000, how much is favorable for him to give the cash for the particular event it happened. It is a contribution of 60 members of your class. So it is not going to be fair if you give all the 60,000 to one more person, because next day or next week any person may also be in the risk. If the total amount is completed in one particular person, remaining problem should be foregone. So how? So in this way, what percentage of the cash should be shared for this event? You are planning, means it comes under risk transfer. Same way, IRDA, that is Insurance Regulatory and Development Authority, also plans how many crores of people are paying the policies, how many crores of people are at losses today. So how much of percentage we should pay for them? This is called as a risk transfer. Company is not paying any cash of its to people. It is paying our cash, our finance to the person who is under the risk. So only it is thinking before it is paying the amount. Next, indemnification. What is the meaning of indemnification here is identifying why the loss has been occurred. What is the reason for this risk? Okay, any third party is there to pay the risk for this accident. Okay, what is the cause for the accident? Complete information it is gathering means it comes under indemnification. Next, meaning of insurance product now. Previously we came across insurance. We also came across the characteristics of the insurance. Now we are learning about insurance product. Insurance products are common financial arrangements in which an insurance provider states its guarantee to pay on covered claims. In return, the buyer agrees to pay a monthly premium cost. So, what is the insurance product? Financial arrangement. Whom you are arranging this finance? The person who is paying the premium as a policy holder to the insurance provider. Who is insurance provider? Insurance company is the insurance provider. So, mutual agreement between the insurer, insured. So, what is the agreement? Finance is the agreement. Premium is the agreement. Okay, so that comes under insurance product. A customer buys insurance to protect against property loss or financial risk. The actual insurance product takes the form of policy binder which states all the terms and conditions including an overview of what events would lead to claim payout. It may be property risk, it may be financial risk during the situation of education, during the situation of sending the children abroad or construction or marriage, any type of event. Insurance company is ready to pay when you join the policy. That is called as a insurance product. So, insurance products, if you see, there are various types of insurance products here. First and the foremost is life insurance product. Next is health or medical insurance products. Property and liability insurance products. Insurance of household goods, marine or transit insurance, vehicle insurance. So, this topic I will explain in detail in second unit because these topics are repeated once again in the second unit. Clear? Next, when you come to types of life insurance products, term insurance, pure endowment insurance, whole life insurance, okay, endowment assurance, universal life insurance, variable life insurance. These are the various types of life insurance products available to the policy holders by the insurance company. Okay, so the first one, if you come for, that is term insurance. So, what is the meaning of the term insurance? You can see here, it is similar to property or liability insurance. This provides risk coverage only for the term selected. What is the meaning? Suppose you want to pay for 1 year. Okay, you want to join the medical policy. You want to join yourself and your family members. Family member composed of 5 members, husband, wife, 2 children and grandmother or grandfather. So 1 year, if you pay 7,000 rupees as a term medical insurance to the insurance company, it provides all the medical facilities to the whole family for 1 year. It may be a bypass surgery, in any type of surgery or any type of accidental situation. the insurance company is going to pay to you, it is acceptable or it is liable to pay only for 1 year. Suppose you pay for 4 years, every year 7,000, 7,000, 7,000 and 7,000. So overall you paid 28,000 for 4 years for 5 members. So 4 years it pays you. So how many number of years you are taking individually, it comes under term insurance. If there is no provision for automatic renewal, that insured can take a fresh policy at fresh cost. So what is happening? Once you take the term insurance, that is applicable for 1 year. Next again the term insurance for second year, third year and fourth year. Clear? There are two types of term policies, renewable and convertible. What is renewable? This year you paid. Next year one more time you want to continue the policy, means no need to purchase the policy again. You make the renovation by paying some renovation charges. Convertible. Term insurance can be converted into whole life insurance. Till you are alive, you can pay the policy, or you can join any types of the policies, means it comes under convertible insurance. Okay, next one, when you come for term insurance, in detail he explained here once again that objective is the family to get a lump sum assured amount in the event of ultimately a death of the family head, bread earner. If the insured survives till the end of the selected period, nothing is payable. Term insurance policy can be issued for 5 years, 10 years, 15 years or 20 years also. The term insurance is there. If you are alive, it is not, means it is, I don't want to say that if you are alive it is not going to be given. If any accident or any event occurs to you, the amount is going to be paid under term insurance. It is a policy with low cost premium. These are required when the coverage is required for stipulated period like tenure. How much loan you want to take also depends upon the policy you took. They give the loan on this policy. Next, when you come for pure endowment life insurance policy, under pure endowment life insurance, there is no accumulation of saving for a specific purpose, daughter's marriage, higher education of the child. Here the lump sum amount is payable only if the insured survives till the end of the selected period. If the insured dies during the period, nothing is payable. Then it is called as a pure endowment policy. If you are alive only, they are paying the policy. If you are not alive, they are not paying the policy. A pure endowment policy is seldom issued. However, a combination of features of term policy and a pure endowment policy gives rise to survival life insurance products. These are two basic building blocks. Survival. So it alerts the policy holder should be strong to take the claim amount under this policy. It makes him internally strong that I should be alive, I should be strong to take the amount at the claimant. Next, whole life insurance. The whole life insurance covers the risk up to the death of the insured. Whenever it occurs, it is sometimes called term insurance for the longest term. There are two types of whole life insurance policies, that is pure whole life, limited payment whole life insurance. In pure whole life policy, the premium is payable throughout life, while in the second case of attaining the age up to 60 or 70 years. So limited payment policy, what is happening? Up to 60 or 70 it is going to pay. Whole life, after your death only it is going to be paid to your nominee, that is a wife or kids or whatever it is whose name you are mentioning. Whole life. You may ask the question, why to pay unnecessarily this insurance, madam, when we are not able to get the amount when we are alive? You may have the doubt here. But what happens is, This policy you are paying for the benefit of your wife or your children only. With that intention only you are joining this policy. So after you are leaving the world, it may be helpful to your wife or your kids. In that way it is going to help you. Okay, whole life policy, again premium for pure whole life policy is lower than the limited payment of the whole life insurance. So pure endowment policy is having less amount when compared to whole life insurance amount. The whole life policy can have a convertible future, allowing it to be converted to an endowment assurance policy. This is suitable for young service entrants who can pay a low premium during. Suppose age is very less, premium rate is also less. If age is big, premium rate is also big. Clear? Endowment assurance policy. This is most popular policy in which the insurer agrees to pay the insurance money in the event of death of occurred during the endowment term and pay the insurance money in the event the insured survives till the end of the endowment term. This is combination of features of term policy and a pure endowment policy. This operates as a combination of gradually decreasing term plan plus gradually increasing investment. What is the meaning of this? Any event occurs to you, it is paying the amount. It may pay the amount after your retirement. It may pay the amount after the maturity of the policy, or it also pay the amount when you are in demand of money. When you expire also the money is paid, before you are died also, means if you are alive also the amount is paid under this policy. Endowment assurance, if you see, investments gradually accumulates as a reserve on the accelerated fashion, and this reserves with the term insurance value added up to the face value of the policy. Premium rates are usually high when compared to whole life insurance. In endowment policy, premium rate is less, whereas in whole life insurance the premium rate is high. However, if the term of endowment is very long, then the premium usually also marginally higher. If the term is long, means rate of premium is also high. Question: what is premium? Premium means the amount what you are paying regularly to the insurance company comes under premium. If you pay regularly the premium only, you can get the claim when the policy expires. Universal and variable life insurance, when you come for, these have potential to accumulate cash value. In case of universal life insurance, investment is done by insurer assuring a minimum guaranteed return. In case of variable life insurance, the insured will have a choice of way the cash value is to be invested. When premium is paid, the insurer deducts a charge and invests that net either as an universal investment or as a variable investment stated above. Okay, universal life insurance, if you see, an attractive feature of this policy is that insured can vary his or annual death benefit and annual premium. The insured can also partially surrender the policy and take loans against the cash value. Means suppose you have the policy. After 5 years, actually you are paying the policy for 10 years. After 5 years, you are in need of some amount and you don't have any security. At that time, you can stop this policy. On that, you can take the loan or you can take the amount what is existing under that policy. That is called as cash value return. Okay, she can add up cash portion of the policy by making increasing investment. Normally, there is no guarantee return applied to the policy. Once you take this surrender value or cash policy, again the promise should be renewed or again you should join the policy. When you come for variable life insurance, it is a form of whole life insurance where a portion of premium goes to the term life insurance part, a part for the administrative expenses of the insurer, and balance goes towards the investment or cash value. The insured decides how and where to invest the cash value of the investment. So some amount is deducted. Suppose you are paying monthly 2000 rupees as a premium for the insurance company, means out of this 2000 rupees monthly, it may take 20 rupees or 18 rupees as the expenses charging to you to process the account. Okay, that is one thing, and you can also take the cash value on this. Clear? So I request all the students to concentrate on the classes and listen the classes. Thank you. Stay home, stay safe, listen the classes. We are not going to repeat the classes once again. Okay.